Dear learners, welcome you all for the session. In this session, I am going to explain about the concept of investment. So the word investment, it sacrifices the current money for getting future benefit. So the current returns are going to be accumulated, are going to be stored for getting the future benefit. The purpose of investment serve for this reason. The people are making investment over the period of time for the purpose fulfilling of their needs and wants in future. So that is what the sacrifice of current money, sacrifice of current returns or the current income generated by the people. So the investor wants to invest to get benefit over the period of time. Basically the investment is done for a period of long horizon, longer period of time. So basically this going to serve or going to reap the huge benefit in future. There are key aspects of investment that deals with the time, risk and time and risk. Both are the important concept to know about the value of investment over the period of time. So the time is an important factor for the investment. So currently you have a money that the money is going to be invested into the market or invested into the various investment avenues. You are going for a fixed deposit scheme. You are going to invest for a period of 5 years, going to invest for a period of 10 years. But urgently that money is going to be used in near future. Maybe in another 1 year, maybe in another 2 years you are going to use this money. Hence, you are not going for the investment of 5 years. You are not going for an investment of 3 years. So, according to your requirement, you are going for investment. So, that is an important aspect that you need to know about. The time is an important factor for determining the investment. So, based on that, the people wants to invest into the market. Either a marketable instruments or non-marketable instrument, they are going to invest. The risk is an important concept. Each investment avenues or each investment alternatives observes the kind of a risk, expose the kind of a risk while the investor is going to invest into such schemes. Like investment in banks, investment in post office is different from investment in stock market, investment in mutual funds, investment in gold. It is entirely differ. Each type of investment alternatives are having a kind of a risk. So risk is a variation in returns. Normally what we denote the risk is an uncertainty. Here is an uncertainty in terms of returns. There are different types of risk which are associated with the investment. Maybe a kind of a default risk, maybe a kind of a credit risk. There are different such kind of a risk which are associated with that. Normally in terms the risk is going to be measured in terms the return generated by the particular investment over the period of time. Based on that, the risk is classified into the systematic risk and unsystematic risk. The systematic risk is being measured comparing the return generated by the particular instrument that compared with the return generated by the market. So basically the market is a base, market is a benchmark index. On that base in which the return generated by the particular stock or the return generated by the particular instrument is being measured. What is the return is given by the market as a whole? What is the return is generated by the particular instrument? Return generated by the particular stock is being compared. We call it as systematic risk. How does the stocks are going to make changes in the market? How the market prices are reflecting? What is the overall return generated by the market and what is the overall return generated by the individual stock in the market is being compared in the systematic risk. Whereas unsystematic risk is an individual risk. So total risk is being calculated. So the way in which the risks are calculated, So the investors are going to invest into the market on the basis of risk exposure that available for different investment avenues, or exposed towards the different investment avenues. On the basis they are going to make investment. And together, some people are cautious about the time, some people are cautious about the risk, some people are cautious about the time as well as the risk. What is the time in which I am going to invest? What would be the return I am going to generate over the period of time? So normally what the investor is cautious towards the time and risk. So these are the basic aspects for selection of investment avenues. And investment in assets, which we classified into two major categories. So normally how the investment is going to be done. So normally what the investment, we are going for an investment, it is like the financial assets, making investment into banks, into post office, into the stock market, or investment into mutual funds, or investment into exchange traded funds. There are specialized categories in which you are going for investment. Either which we simply classify into the marketable financial instruments and non-marketable financial instruments in which the investors are going to invest. Whereas the real assets, they are going to buy the land, they are going to buy the commercial property, they are going to buy the residential property, they are going to buy the gold physically, or other bullions, valuable bullions, they are going to buy it in the market. Valuable stones, they are going to buy it in the market, or antiques or other collectibles, items in which they are making investment. These are the things we classified as real assets. And about the financial asset, into the financial instruments. It is investment which is diverted to the financial instruments, which we classified as marketable financial instruments and non-marketable financial instruments, or the major classification. According to Benjamin Graham, define the term of investment. It is an investment operation is one which, upon the thorough analysis, promises the safety of principal and an adequate returns. Operations are not meeting these requirements, or call it as a speculation, or call it as a speculative reason in which you are making investment. So the investment is clearly defined by the Benjamin Graham. The first aspect that I'll just take from this definition, it is investment operation is depends on the thorough analysis. That is a very basic fundamental for the investment. Investor who are going to make investment, it is for the long horizon they are going for the investment. However, the investors are going for long-term investment into the market, they should go for the thorough analysis. It's like, from the preparatory session or the preliminary session, introductory session itself, that the valuation concepts, valuation of shares, debentures or bonds, different types of instruments, how you are going to evaluate. There are a type of analysis we can classify into fundamental analysis and technical analysis. The fundamental analysis aims to establish the intrinsic value of such securities which are traded in the market on the basis of its book price, on the basis of the value of asset, on the basis of relative strength index, on the basis of industrial scenario, on the basis of as the economy as a whole is being studied, where we are going to understanding the real worth of the particular stock, it is traded in the market. That is what we call it as, it is establishing intrinsic value of such securities. One thing. Then the second important aspect, when the investors are moving on to the technical analysis, rather insufficient data is available in the market, or the investment not done for the long horizon, the investment is being done for the short horizon or a short period of time. So that particular point of time, might be going for the technical analysis. Using price and volume related data, using charting techniques to estimate the behavior of price over the period of time, understand the trend it is prevailing in the market, either it may be a bullish trend or a bearish trend. When those stock prices are increasing continuously in the market, it is observed as a bullish trend. When those stock prices are decreasing over the period of time, continuously decreasing, steep declining in the market, it is observed as a bearish trend in the market. Based on the movement, based on the trend it is prevailing in the market, the investment is being done by the investors. But here the Benjamin Graham has given the clear understanding about the concept of investment. Investment should be done with the proper analysis. The second important aspect of investment should promise the safety of principal. Whatever the amount is being invested, that should give the basic protection about the capital what you have invested, the principal amount what you have invested on this. You don't have any kind of risk in non-marketable financial instruments. Whereas a marketable financial instrument, you might have a kind of a risk that is exposed towards, they are not assuring for the guarantee of principal amount. But what the definition is insisting, at least should get their value back in the market. That should give the basic safety to the principal amount what is being invested by the investors in the market. And the third important aspect, provide the adequate returns to the investment. So the returns, we are classifying into the two different types of returns, current returns and capital appreciation. You can say the thing, it is the components of returns, components of total return. The total return is arrived from the calculation of or summation of the current return plus capital appreciation. So that should ensure for at least the adequate return can be provided. That should be above the nominal rate of return is available in the market or above the risk-free rate of return. And what is a risk is being taken by the investor, that should be compensated with the returns given by the particular investment. So that is what the meaning of adequate return. The return should be adequate. Return should be compensated with the risk taken by the investor in the market. And the operations are not meeting these requirements, at least for the thorough analysis, safety to the principal amount, adequate return. If those investment avenues not assuring for this is considered as a speculative. The speculative reason only the investors are making investment. Without any fundamentals, they are going to invest into the market for getting a short gain in the market. So that is not at all being considered as an investment. So hope you all understand about the concept of investment from the point of view of Benjamin Graham. The next one, so in this particular definition, I have used the two words called the investment and speculation. So the investor who done for long horizon for making investment into the market, or the people who wants to go for market for a short horizon for making abnormal rate of return from the market, exploiting the market opportunities, the people are moving towards that without doing any fundamental analysis. Without doing any analysis, the people are moving towards that. Those people, we call it as a speculators. So here you need to know about the difference between the investors and speculators. So the first one, the investor and speculator is being classified on some basis. So the first basis of classification is planning horizon. What is the time or the tenure taken by the people for making investment into the market? So the planning horizon for the investor, it's a long planning horizon for the longer period of time. People would like to hold at least for a period of 1 year. At least you should make the investment into the market for the period of 1 year. Those people at least call it as an investor. But the people who are going for short horizon, short planning horizon, day to day, they are making a few days or few weeks or few months, they are holding that particular instrument for generating the profit. Those people are called it as a speculator. So in this differentiation, you need to know about the planning horizon is an important aspect. The planning time or the tenure in which you are planning, the time in which you are planning is going to provide the base in which the investor plan for long horizon, whereas the speculators plan for short horizon. The second one, the risk disposition. What is risk disposition? It is the risk-taking ability of the people, how it is going to be compensated in the investment point of view, as well as the speculators are taking. The first one, the investor not willing to assume more risk than the moderate risk. Rarely they assume the high risk. So generally the investor plan for long horizon. So they don't want to take huge risk. They normally take, or what we can say, it is moderate risk is being assumed by the investor. Rarely the investors are taking the high risk. But the speculators ordinarily willing to take the high risk. Because the market speculation, as you know that the bullish trend and bearish trend, when the people are ready to invest into the market with a speculative reason, they might invest during the bearish trend. When it turns into the bullish trend, they will generate the profit and run away from the market. Or even they buy in the bearish trend and even sell it in the bearish trend, or buy it in the bullish trend and sell it in the bullish trend. So they will do it on the time horizon in which they are making investment into the market. So they might normally assume the kind of a profit or a loss. They hold the time. Time is a very important aspect for the speculators because the planning horizon is too short. The third important differentiation, it is risk expectation. So the risk expectation, moderate rate of return is expected by the investor with the assumed risk, with the risk taken by the investor, they can expect the returns. But the speculators are normally wants to take the high rate of return because they assumed the high risk. So they are making investment into the market 1 lakh. At least they want to generate some 1,20,000, 1,40,000 in a week of time. So those people are what we call it as speculators because they are taking a huge risk. Maybe their investment that too comes from 1 lakh to 60,000. So they want to take a kind of a risk. For that reason, they expect the higher rate of return from the market. But the investor stay with the investment for longer period of time. So they expect the moderate rate of return. At least it should be above the rate of return given by the market. Especially for the risk-free investment. More than that they expect from the market. And another classification of differentiation, it is on the basis of decision taken by the people. Investors, based on the fundamental factors, careful evaluation of prospects of a firm in future, based on that they are going for investment. They will conduct the economic analysis. In that, what would be the growth of economy, which sector is contributing more growth to the economy. They will select those sector for making investment in that particular sector or the industry. What are the firms are performing well? Those firms are selected and those firms are being evaluated in terms of their financial position. After that, the investor wants to make investment. So that is what we call it as a fundamental factors are carefully evaluated for making investment. Whereas can say the decision taken by the speculator, it is like the hearsay, technical analysis, technical charts, the market psychology, investor sentiment are taken into the consideration for making investment for a short horizon into the market, for getting the abnormal rate of return. And the leverages, normally where the fund is being sourced by the people. The investors are sourcing on their own fund, they don't want to borrow from the market. But the speculator wants to borrow and they can use their own resources. Why they borrow the funds from the market? Because they wants to get borrow the funds at cheaper cost or lower rate of lower interest rate. They will borrow from the market and they will invest into the market for getting higher rate of return. The more exposure, the risk exposure taken by the speculator compared to the investor. So you know about the investment speculation. Next important aspect to know about the gambling. It is more than the concept of speculation. It is purely done like a gambling. It is not at all doing any analysis. It is very few hours, very few minutes they wants to generate the profit out of the market. Those process we call it as gambling. So the gambling is more quickly compared to the, if you are taking a time horizon from the investment point of view or from the speculation point of view, this is being done more quickly. That we can take at least for a 1 year for investment, few days or few months for speculation, few hours for gambling. They invest in the morning, they want to generate the profit at the evening. That more quickly the people running towards generating the profit. We call it as a gambling. Second one, based on the risk created artificially. So they will make a kind of a thing in the market. They'll anonymously, they are going to make investment into some stocks. Even those stocks are not having any fundamentals. They are making investment. So what might be happen if those stocks are going to increase, the prices of those stocks are increasing. The people are running towards that particular stock for purchasing because those prices are increasing. They want to sell their stock with a higher price because of the kind of a demand is created artificially. So you know the concept of efficiency of market. Market is purely driven by the information, private information, public information, and the market related data. But those market related data can be manipulated in the gambling because of some investor wants to make invest. Steady they are going to make invest. Over the period they are going to make invest into such stock, even those stocks are not having any fundamentals. So if those stock prices are increasing in the market, other investors are also wants to make invest. After a period of time, they wants to liquidate their funds from the market, they run away from the market. So that quickly happens, we call it as gambling. Create a risk without providing any compensate with the economic return. It is not we are calculating this is what the portion of risk you have taken, this is what the return is expected. Because the risk is created artificially. We are not able to compare what would be the return can be generated. So the gambling is more quickly, is kind of the more risk-taking ability of a people. They are going for a kind of gambling. Investment alternatives. Here you can find the different investment alternatives are available. It's deposit schemes, government securities, money market instruments, bonds or debentures, equity shares, mutual fund schemes, insurance products, retirement products, real estate, precious objects, or the major investment alternatives. The first one, deposits. There are different deposit schemes are floated by the different institutions, banks and post office, company fixed deposit schemes, or such major schemes of deposit. The first one, bank deposits. Banks are floating different deposit schemes. It's like the recurring deposits, saving deposit schemes, current deposits, term deposit schemes, fixed deposits, floated by the banks. Like the ICICI has floated the different deposit schemes like 333 days deposit, 555 days deposit scheme, 666 days deposit schemes. Special deposit schemes are also floated into the market. And like the post office deposit schemes, recurring deposits, National Savings Certificate, Kishan Vikas Patra, The different deposit schemes are also floated by the post office. Company fixed deposit schemes. Companies are floating fixed deposit schemes like public deposits. Public can invest, public can deposit their money into the companies. It is floated by the manufacturing companies, like for example of Sakti Sugar, floating a public deposit schemes. NBFCs, non-banking financial companies, are also floating such deposit schemes like Muthoot. Like the companies or different deposit schemes are also floated by the companies. So the companies, banks and post office are issuing major deposit schemes to the market. Some government deposit schemes are also accepted. They are also act as a nodal agency for collecting those deposits from the market. For example, SSY, Suganya Samruddha Yojana, for girl children, the scheme is collected by the banks and post offices, involving with the process of collecting the funds from the market, funds from the public. Second one, government saving schemes. That the government saving scheme, post office or selected banks as a nodal agency, special purpose vehicle for promoting such schemes. For example of public provident funds with the interest rate of 8%, and senior citizen saving scheme, normally compared to the normal citizen 0.25 or 0.5% higher, or the basic points are being given to the senior citizens. And national saving certificate, normally can get it from the post office. Kishan Vikas Patra, normally the national saving certificate is being given for 8% interest rate. Kishan Vikas Patra is available in the market for 7.7% of interest rate. Money market instruments. Money market instruments are specialized instruments which are being issued by the banks and financial institutions. Government is also government is also issuing the instruments in the market. Those instruments are having a negligible risk. The risk, too low risk, is associated with kind of instruments. Those instruments are like treasury bills, certificate of deposit, commercial papers and repos. First one, treasury bills. Treasury bills are normally issued by the government on behalf of the government. Reserve Bank is issuing a treasury bill. Treasury bills are subscribed by the institutions. Rarely the individual investors are participating. Why rarely the individual investors are participating in the money market? Because the value of transaction is high. So for that, the individuals cannot be participated directly. It can be participated through the other investment vehicles. Like for example of collective investment vehicle. Mutual fund is doing that particular process. Insurance companies, through which the retail investor can able to enter into the money market, because the value of transaction is high. The second one, it is like the treasury bill, normally issued by the government on behalf of the government. Reserve Bank is issuing that. This instrument is issued by Reserve Bank on behalf of the government. It is issued at the discount rate and redeemed at the par rate. It means there is no explicit rate of interest. It is the implicit rate is applicable for this instrument. We call it as a treasury bills. Treasury bills normally issued by the government to fulfill its short-term obligation. For the purpose, the government is government is issuing such instrument in the market. Normally with the denomination of 91 days, 182 days, 273 days and 364 days denomination in which the instruments are issued in the market. Interest for this instrument is calculated on the weekly basis. For example, 100 rupee worth of treasury bill is being issued in the market for 90 rupees, for example. So at the time of maturity, you can get 100 rupee. It means what is the rate of return you can generate out of this particular instrument? You can get 10 rupee. You have invested 90 rupee, you can get 10 rupee. So 10 divided by 90, you might get 11.11 percentage of interest, but it is not an explicit rate, it is implicit rate. It is being calculated. What is the rate in which the instrument is issued in the market? On the basis the rate is calculated, it is being published by RBI on weekly basis for the treasury bills. The second one is a certificate of deposit being issued for the period of 7 days to 1 year. It is being issued by the banks, whereas the other financial institutions issuing this certificate of deposit for the period of 1 year to 3 years they are issuing. It is being based on the market rate, based on the credit rate prevailing in the market, the credit policy of RBI, the rate of return for such instrument, it depends on that. That is what it is being issued at the floating rate of return given by that instrument. We call it as certificate of deposit. The commercial papers is unsecured promissory note. Is being issued, slightly the interest rate is higher compared to all other instruments. And this instrument, the commercial paper, is being issued in the market for the period of 7 days to 1 year. It is being sold in the market at the discount rate and redeemed at the par rate. That is what the commercial papers are also having implicit rate of return. And the repos, repossession agreements, call money, interbank financial transaction are the major money market instruments. Next important thing is the equity shares. You know that the equity share is a ownership share. It's being issued by the company. The investor can subscribe for this equity share. Investor, whoever subscribing the equity share of such company, they call it as a owners of that company. They will get the ownership rights from that particular company. That the importance of equity share. The equity share is having understand about the risk, moderate risk to high level of risk is associated with this instrument, because whatever the risk, whatever the loss happens into the business is being borne by the is being borne by the equity shareholders of the company. And we can classify the equity share on the basis of its performance in the market. On the basis of the characteristics of the company, we can classify it into blue chip shares, growth shares, income shares, cyclical shares, speculative shares, defensive shares. The first one, blue chip shares. Those companies are well established companies, large scale enterprises, large capitalized companies, financially sound company. They are stand in that the category of blue chip companies. Those the level of risk is low, the return, average rate of return can be expected from that particular kind of companies. We can classify as blue chip companies. Simply we can say large, well established company, financially sound, they call it as a blue chip companies, blue chip shares. Second one, growth shares. It provides the rate of return above the average rate of return given by the market. So those shares we call it as growth shares, potential for future. And the income shares might provide the higher rate of dividend. Compared to that, you know that the return we can classify into the capital appreciation and the current return. The capital appreciation is a difference between the purchasing price and the current market price or the selling price. Current return is generated by holding that particular instrument, maybe in the form of interest, maybe in the form of dividend declared by the particular company. So here high dividend is declared by the company. Maybe a company is in the declining stage. They don't have any further investment option, because out of earnings the company is planning to give the dividend or planning to retain for the future purpose. If those companies giving higher dividend, it implies that the company may not have the future potential. Company may not have further investment options. So those companies can give the higher dividend to the investors. So normally the higher income shares can be classified as those companies who are giving higher dividend to the shareholders. cyclical shares based on the operations we can classify as a cyclical shares, because those shares are increasing one particular period of time when they have high level of production in the market or sales happens in the market, and those prices are reversed back into its origin. Those shares we can classify as a cyclical shares. You know that the majority of FMCG products during festival time it is increasing. After that, the price of that shares is slightly reversing in the market. Some shares we can classify as a cyclical shares based on its operation in terms of its production or in terms of its sales happens in the market. Based on that, we can classify those shares into the cyclical shares. Speculative shares, it's a fluctuating. The price is fluctuating. Those shares are indicative that those shares can be purchased only for the speculative reason. You know that majority of the shares have some point, we can call it as the average price, in which that particular share can be stay for longer period of time. Let's say, for example, one particular share is being selling in the market for 160 rupees for longer period of time. We assume that particular price is the average price of the particular stock. One particular point of time, it is going to increase to 165. People are buying at 160, would like to sell it at 165. They tend to reverse the position in the longer period of time. That we call it as speculative shares. Defensive shares, which are stable and the rate of return given by the particular stock is going to slightly increasing over the period of time. It is like 160, 161, 62, 63. It is increasing. We can say that particular stock is a defensive in nature. Whatever the fluctuation which happens in the market, it does not affect much on that particular stock, which we can classify as a defensive stocks. So these are the major classification of equity shares. And the mutual funds, we can classify the mutual funds into equity oriented fund, debt funds, and we can classify into hybrid schemes. There are such classifications of mutual fund scheme. Before understanding about the mutual funds, you need to know about schemes. You need to know about the mutual fund, the concept of mutual fund. What is mutual fund? Mutual fund is a vehicle for collecting investment from the investor and invest into the various investment avenues or various investment alternatives. It means the mutual fund is called it as a collective investment vehicle, because as in the introductory session, I just explained, if you have 70,000 rupees only, you can be able to buy one share from Nifty, each one share from the companies listed in Nifty. But the mutual fund is providing you the opportunity. You can participate, you can buy the number of shares from the number of companies. You are not exactly going to buy the number of shares, you are going to subscribing a portion of shares from the company. Just like the concept of mutual fund. Mutual fund is a portfolio. It is going to invest across the different investment alternatives. So the concept we call it as a mutual fund. Mutual fund is also comes under the regulation of Securities Exchange Board of India. The SEBI Mutual Fund Regulation Act 1996 is controlling the operations of mutual fund in India. So according to the performance of mutual fund, it is classified into the equity shares, debt schemes and hybrid schemes. Equity schemes, asset management company has investing major portion of funds into equity and equity related items. According to that, the proportion of investment that asset management company is investing into equity and equity related item, there are different schemes are formulated. The first one, diversified equity scheme. Irrespective of sector, irrespective of companies, it is investing across the different companies which representing the different sectors of economy. Investing the companies representing the agricultural sector, investing the companies which are representing the industrial sector, investing the companies which are representing the services sector of the economy. Almost all the sectors in which the investment is going to be proposed by the asset management company, the scheme we call it as diversified equity scheme. So in this scheme, let's say for example, a company is going to invest. It's like a representing of automobile industries, banking, financial services, agro-based companies, real estate companies, like the heavy engine manufacturing units. So representing the different sectors of economy, the investment is proposed by the asset management company. The type of a scheme, a special type of a scheme, we call it as diversified equity scheme. The second one, index schemes. It is also a kind of a diversified equity scheme, where the diversified equity scheme, the asset management company is planning where they are going to invest. What is the plan of investment? The weightage of investment to the specific asset is to be defined. Whereas in this index scheme, the index is guiding the asset management company for making investment. Whatever the weightage is being assigned by the index based on the market capitalization of the companies, similar way this particular scheme is going to invest. Let's say for example, S&P CNX Nifty. Nifty consists of top 50 companies taken into the calculation of that particular index. So if I'm an asset management company, I'm going to replicate the index. Replicate the index, what Nifty is doing. What Nifty consists of stocks. Those 50 stocks I'm going to make investment. So I just over the period I'm going to compare the performance of my portfolio, my index fund compared to the benchmark index is to be measured. So that specific scheme we call it as index schemes. And sectoral scheme, irrespective of going for a concept of diversification of risk, irrespective of that, people are specifically wants to invest into the specific stocks, specific sector of the economy. I just wanted to invest into automobile sector. I just wanted to invest into the banking sector. I just wanted to invest into the financial services sector. I just wanted to invest into the infrastructure. So likewise, the different sectors in which the investment is proposed by the asset management company, we call it as sectoral funds. And tax planning schemes. The majority of the schemes under this particular concept of mutual funds aiming for tax reduction to the investors. With that point, they have the tax planning scheme. With that tax planning scheme, major proportion of funds are invested into equity and equity related items. More than 80% is being invested. That also eligible for getting the tax exemption under such schemes. We call it as tax planning schemes. ELSS are also the best example for the tax planning schemes. Equity linked saving schemes. So let's take quickly, just recall equity schemes with few examples from the asset management company. For the first one, diversified equity schemes. There are the number of asset management companies who are offering more than 1,000 schemes in the market. There are few schemes which are giving the highest rate of return to the investor in each specific categories of investment. The specific category like the diversified equity scheme, Reliance Asset Management Company is doing well in the market. That scheme we call it as Reliance Diversified Equity Scheme. IPRO Diversified Equity Scheme, ICICI Prudential, or the benchmark schemes, or we can say it is top rated schemes, or it is top performing schemes in the market. The second one, like index scheme, every company is offering such a scheme, is replication of S&P CNX Nifty or Sensex or Junior Nifty or CNX 100 or 200 or 500, small cap, mid cap, large cap. So like for the specific index which is owned by the stock exchange is being taken as a replication for construction of portfolio by the asset management companies. That scheme we call it as index scheme. So the best example for the index scheme, Aditya Birla Nifty is the best example for the index schemes. And sectoral scheme, ICICI Prudential Automobile Industry, ICICI Prudential Banking Financial Services Industry is representing the particular scheme which is representing the particular sector of the economy. Like the tax planning scheme, SBI tax planning, tax saver schemes that they have. Like the best example, what is going on in the industry part is given as example for the equity oriented schemes. Let you can take from the debt scheme the major portion of fund which are invested by the asset management companies into a debenture or debenture oriented items. Investing into the bonds, investing into the debentures, investing into the public deposits issued by the companies. So those investments we call it as the debt oriented investment. And this particular scheme, the investor wants to invest in majority of the funds are to be invested into debt oriented items. So like you can take the first one, the equity scheme, aggressive investor who wants to generate more returns, or we can say it is expecting the higher rate of return from the investment. Those investor wants to invest into equity schemes. Whereas the conservative investor, the investor who don't want to lose their money into the market fluctuations, those type of investors are investing into debt oriented schemes. So those investors we may classify as a conservative investor, even though the expected rate of return on that particular investment is low. They are accepting, since they want to protect their capital, what they have been invested into the market. They want to protect their investment, what is to be invested into the market. So in that case, the kind of schemes like gilt schemes, mixed schemes, floating rate, debenture schemes, money market schemes, or we can say it is liquid scheme or liquidity funds. The first one, gilt scheme, is aimed to invest into the top rated government bonds where the investment is going to be invested. Majority of the investment is invested on such a scheme. We call it as it is gilt schemes. Glittering is the best example for this particular scheme. It's like infrastructure bonds, 20 years infrastructure bonds where the fund is going to be invested. Like the high rated, the government securities, treasury bonds, like the kind of investment this particular scheme is investing, we call it as gilt scheme. Mixed scheme, across the different debentures, across the different debt instruments in which the investment is going to be proposed. It's like it is investing into the bonds issued by the government, bonds issued by the banks and financial institutions. For example, like it is going to invest into the RBI saving bond, 15-year infrastructure bond, 20-year infrastructure bond. Like that, across the different investment, across the different categories of debt investment in which it is going to invest. What we call it as the gilt scheme. And it is second one, the mixed scheme. And the floating rate debt scheme, it depends on the market, condition. Whatever the rate it is prevailing in the market, it is based on the credit policy of Reserve Bank of India. Whenever the Reserve Bank of India is going to make the changes in its policy rates, according to that, the deposit rates are going to change in the market. Where the investment is going to propose to buy the asset management companies, those investment rates are also according to the changes of those market rates or policy rates. Those instruments we call it as floating rate debt schemes. And the money market schemes, as you know about the money market is a short-term market where you can mobilize the funds, where you can invest. Here, what you are doing, you as an investor, you're going to invest into the market scheme, money market scheme. It means it's a liquid scheme. We call it as a liquidity scheme or cash market scheme, where the investment are going to be proposed under this particular scheme is highly secure for the investment made by the investor. Accordingly, the rate of return is also low under this particular scheme. Where in this scheme, LIC is leading on this particular scheme. LIC Liquid Fund is leading across the different other companies, other asset management companies in the market. The hybrid scheme is a combination of debt and the combination of an equity. Both are to be combined together. We call it as hybrid scheme. The proportion of equity investment, the proportion of funds are to be invested into debt. The proportion of funds are also invested into the money market segment. So that investment we call it as hybrid schemes. The first one, equity oriented scheme. It means the major portion of funds are invested into equity and equity related items, and the remaining portion of funds are invested into debt and money market instruments. That scheme we call it as equity oriented schemes. And the debt oriented scheme, the major portion of funds are to be invested into debentures, whereas the minor portion of funds are to be invested into equity oriented instruments. Whereas the variable asset allocation, it depends on the market condition. Debt to equity, equity to debt, the allocation is to be done under such a scheme. We call it as variable asset allocation schemes. So these are the schemes, basically what we can classify as their hybrid schemes. So the types of schemes or types of mutual funds we can classify into equity, classify into debt, classify into hybrid scheme. Equity scheme, the major portion of funds, it means it is more than 80% of the funds are invested into equity and equity related items. Whereas the debt scheme, major portion of more than 80% of the funds are being invested into debenture. Whereas the hybrid scheme is a combination of debt and equity combined together is invested into the market. And there are such regulation that the students needs to know about how the mutual funds are regulated in the market. With this, the regulations of mutual funds, the entire operations of mutual fund is regulated by Securities Exchange Board of India under its special regulation which was passed during the year 1996. That regulation we call it as SEBI Mutual Fund Regulation Act 1996 is covering the entire operations of mutual funds in India. Mutual fund must adhere the principles of advertisement. So it is not going to give the kind of advertisement, the rate of return what it is going to be given by the particular scheme, because you know that the mutual fund investments are subject to the market risk. So the kind of a caution notice is also to be given to the investor who wants to make investment. But they need to explain why the investor wants to invest in mutual fund. What is the benefit out of mutual fund? So that only needs to explain under the advertisement. So those principles are covering under this particular regulation. The second one, in case of an open-ended scheme. So you know about open-ended scheme, closed-ended scheme and interval schemes. You need to understand before this. So the mutual funds, classification of mutual funds according to the investment, you know that it is equity oriented scheme, debt oriented scheme and hybrid scheme. There is another type of classification of mutual fund. It is called it as based on the duration, based on the entry and exit. The mutual funds are classified into open-ended scheme, closed-ended scheme, interval schemes. Where you can take the open-ended scheme, the investor can join at any point of time. Investor can exit at any point of time. There is no login period. Let's say, for example, if I'm an investor, I have invested into open-ended scheme. Like I have invested on 1st April 2022. I just wanted to get back my investment on 1st September 2022 or 3rd September 2022, not an issue. such a scheme we call it as open-ended scheme. Whereas a closed-ended scheme, there is a specific advertisement is given by the asset management company for such a scheme for mobilizing the funds from the market. It is like similar to IPO, it is called it as NFO, new fund offer. So during the new fund offer, the investment is collected from the investor and specific scheme is created, and this scheme doesn't allow the further investment from the investor after the specific period of time. There should be a login period is applicable for such schemes. We call it as closed-ended scheme. It will remains closed. Subscription remains closed for such a scheme. Redemption remains closed for such a schemes. We call it as closed-ended scheme. Let's say, for example, the scheme has started on 1st April 2022. It remains on the closed-ended scheme. The login period is applicable for the investor till 31st March 2025. So there should be a login period of the years, number of years in which applicable for the investors. So in this particular example that you need to understand that there are about the 3 years is a login period for such a scheme. Similarly, there are during the period investor cannot able to liquidate their funds. Such a scheme we call it as closed-ended schemes. Whereas the interval scheme, there should be a specific corpus to be collected. Corpus is an investment which is required to start, required to run such schemes in the market by the asset management companies. So that corpus cannot be fully collected by the asset management companies for floating of such a closed-ended scheme. They can able to float the interval schemes in the market. Interval schemes are the special type of closed-ended schemes. So based on the requirement of asset management company, they can able to mobilize the funds from the market. Let's say, for example, if I'm going to float a diversified equity scheme, it is to be a closed-ended scheme. It's just asset management company, Reliance Asset Management Company Limited. So Reliance Asset Management Company Limited has planned to issue such closed-ended scheme in the market. They need a corpus of 200 crores. They planned to issue the application during 23rd of March 2022 and closing the application on 30th of March 2022. And the launching of scheme into the market on 1st April 2022 and the closed-ended scheme that remains till 31st of March 2025. So you know that the time period, it's like 1 week of time period is given for the investor to collect the funds from them. So they are floating such schemes in the market. What is the name of the scheme? The name of the scheme is Reliance Diversified Asset Management. It means Reliance Diversified Schemes. 1 week time is given to the investor for investment. So how much investment is expected from the investors? It is around 200 crores are expected from the investor. And the scheme remains till 2025. After that only the investor can able to get back their investment from the market. So what may happen this particular point of time? During the 1 week, they have collected around 140 crores. It means the expected corpus of 200 crore cannot be collected from the investor. So what they plan, according to their existing plan, they are going to launch the scheme on 1st April 2022. That is not an issue. But what the company is doing, remaining fund of 60 crore can be collected from the market for running or full-fledged functioning of such a scheme in the market. So they planned to issue a special closed-ended scheme, what we call it as a interval schemes in the market. Maybe such interval schemes are to be floated by the asset management company during the period of April. It is like the 10th of April to 18th of April, they may be given a time for the investor to make investment, subsequent investment into the market by such a scheme, what we call it as interval scheme. After that, the 3 years also the kind of login period for the investors. So accordingly, what we can classify the schemes based on the duration or based on the entry and exit norms. We can classify the schemes into open-ended schemes, classify the schemes into closed-ended schemes, classify the schemes into interval schemes. The open-ended scheme that remains open as long as company wants to go for that scheme in the market, that remains open. Anytime can invest, anytime can exit from the market. That can be possible under such a scheme. We call it as open-ended scheme. Whereas a closed-ended scheme, there should be a login period. Once the investor has invested, the investor needs to wait for a period of time for getting their investment back from the market. Whereas the it is the interval schemes are the special type of closed-ended schemes. So where in this particular point, you need to understand that while I'm an investor, I'm going to invest into the market, I have few criteria for evaluating the investment alternatives. It is like marketability, it is like the liquidity, taxability, convenience, or such criteria, where I can take that particular criteria into the consideration, where the liquidity level of open-ended scheme is high compared to that the liquidity level is low in the closed-ended scheme, where you know the concept of liquidity. The liquidity is converting into cash. You have invested into open-ended scheme. How quickly, how effectively I can able to liquidate my funds into the market? I can get back my investment into the market. How I can convert my investment into cash? That the concept what we call it is a liquidity, whereas the liquidity level is too low for the closed-ended scheme because you need to wait for a period of time until the investment is going to close in the market. So such kind of things what we can say is the difference between the open-ended and the closed-ended schemes in terms of liquidity. And you know that for that overcoming that particular limitation into the closed-ended schemes, the marketability has been introduced for the closed-ended scheme. Those closed-ended schemes can be listed into the stock exchanges for further liquidation into the market. It means as similar to that the investor how they are going to buy the shares from the market, similar way they can be able to buy the units of such schemes floated by the asset management companies from the market. And they can be able to buy the units in the market, sell the units in the market. So there is a secondary market is opened for closed-ended schemes. So that is the basic thing that you need to understand about the open-ended scheme, closed-ended schemes and interval schemes. Where then the case of regulation, the open-ended schemes and the closed-ended schemes, minimum of 50 crore and 20 crores, the corpus is required as per the guidelines of Securities Exchange Board of India. It means what the 50 crore in case of open-ended scheme, if you as an asset management company, you are going to start a scheme. With that particular scheme, you need to mobilize the minimum capital, minimum investment to be collected from the investor. That concept we call it as a corpus. That to be collected from the investor, at least 50 crores can be collected, minimum. Whereas the corpus to be collected by the closed-ended schemes, at least it should be at 20 crores. The minimum corpus is required. Minimum investment is required for floating of such schemes into the market. This is the guidelines given by the Securities Exchange Board of India. The next one point is insisting mutual funds should invest the money raised from those saving schemes within 9 months from the date of investment. Whatever the money is raised, whatever the investment is collected from the investor, from those saving schemes to be invested into the market within the period of 9 months, they need to invest. And the maximum amount that the mutual fund can invest into the money market at 25% in the first month and after the closing of funds, and 15% of corpus in the 6 months for the short-term liquidity, the requirement can be met. So initially it is not advisable that the investor or the asset management company is going to invest asset management company is going to have more than a fund for the money market investment. So it is advised. So the mutual funds are giving a guidelines to the asset management companies that minimum amount the money market can invest, that is around the 25 percentage in the first 6 months after closing the funds, whereas the 15 percentage the corpus after the 6 months they need to maintain. So it can be permitted, you can invest up to 25 percentage during the first 6 months. After that it may be reduced to 15 percentage, since the money market is highly secure, whereas the rate of return given by the money market is too low in the market. So the conservative investor only prefer to make investment into the debt market, even though those conservative investors are not ready to invest into the money market, since the market is given the rate of return which is very low compared to the rate of return given by the banks and financial institutions. So whereas the short-term purpose only it is allowed to park the money by the asset management company. So here the guidelines are given not to the investors, not to the direct investors. It is given to the asset management companies. So what we can say, there are the different entities which can be used for the formulation of mutual funds. Like what we can say as a sponsor, asset management company, custodians, transfer agents, registrar, or such entities which are required, whereas asset management company is an investment company, where I can say the Reliance Asset Management Company Limited, Aditya Birla Asset Management Company Limited, ICICI Prudential Asset Management Company Limited, SBI Magna or SBI Asset Management Company Limited. So in that kind of asset management companies, we call it as investment companies. They are collecting the investment from the investor, and those investment is invested into across the different investment avenues by the asset management company. That is what the asset management company, what I can say as the investment companies in the market. So these are the guidelines which are applicable for the asset management companies. So asset management companies should invest, maybe the maximum of 25% of the funds can be invested into the money market during the first 6 months. After that, it can be reduced to 15% over the period of time, can be invested into the money market. So that money market may be invested into treasury bills, certificate of deposit, commercial papers, repos, call money, wherever the requirement is there, the investment is going to be proposed to by the asset management company on behalf of the investor according to the investment objective of the scheme. The next one, no such scheme can invest more than 15% of its NAV to the rated debt instrument of a single issuer. It's like one particular issuer has issued top rated, or what we can say, it is rated bonds, rated debt instruments. It means those instruments have been rated by the credit rating agencies, like AAA rated bonds, AA rated bonds, or A rated bonds. For example, ONGC has issued such a debt instrument in the market, where your investment for the specific scheme, you know that if you have opened or you have started an open-ended scheme, a minimum corpus of 50 crore is required. If it is a closed-ended scheme, minimum corpus of 20 crore is required to start such a scheme. I have started a scheme for 100 crores. It is about the open-ended scheme. Whereas in that open-ended scheme, I can't permit to make investment into a ONGC debt instrument more than 15 crores of my fund. Can be invested up to 15%, but it should not be more than 15% of the funds are not invested into the debt instrument, rated debt instrument, which are issued by the single issuer. Maybe investing across the different issuer, like ONGC is issuing, BHEL is issuing. It is like the other companies are also issuing. SAIL is issuing, GAIL is issuing in the market, where I can invest into those public sector enterprises. It is not be for the specific issuer, not more than 15%. The limit may be increased to the maximum of 20% with the approval of trustees. So you know there are different entities of mutual fund. Entities are like the sponsor, asset management companies, trustees, custodians, and registrar and transfer agents. Whereas a trustee are formed for the purpose that they are going to make the smooth function of the organization. With their approval, with the approval of trustee, can we go for 20% of the investment into a specific scheme, into a specific issuer who are issuing a rated debt instrument. No scheme can invest 10% of their total NAV. NAV is a concept, what we call it as net asset value. It is based on the market investment of the investment for the specific scheme. After deducting the charges, it can be calculated. Net value of investment is calculated. For unrated papers, unrated debt instruments which are issued by the issuer, it's like the commercial papers. Those kind of instruments, it cannot be invested more than 15%. With that, the total investment of any such schemes into the unrated instrument cannot be exceeded more than 20%, 25% cannot be permitted. So for the single issuer can be invest up to 10% can be possible. But together with the overall investment of market, overall investment of such a scheme cannot be permitted to make invest more than 25% into unrated debt instrument. It means those instruments are not rated properly or expired their rating. Those instruments, we call it as unrated instruments. No fund or all its scheme can hold more than 10% of company's paid up capital. Similar way to that, the debt instruments, it's like a bonds and debenture. Similarly to the equity investment cannot be 10% holding into the paid up capital of a company. That should getting the voting rights of the company, but this particular scheme of mutual fund not for the specific purpose of holding the company. It is just for mere investment, going to generate the rate of return to the investor, not with the aim of controlling the companies. So in that particular scheme, no fund under all its scheme can hold more than 10% of company's paid up capital. No scheme can invest into the unlisted securities of sponsor or its group of entities. Either it should be a sponsor, should not invest any part of amount into the sponsor or the sponsoring group. So that is to be a regulation under the scheme. The scheme can invest into the unlisted securities being issued by the entities or either by the sponsor or group. Open-ended scheme can invest maximum of 5% of the net asset value plus unlisted securities. So the unlisted securities, those securities not listed in any stock exchange, we can classify those securities as unlisted securities. It is not listed in Bombay Stock Exchange, it is not listed in National Stock Exchange. Those securities we can classify as unlisted securities. So investment in these unlisted securities can be controlled by the Securities Exchange Board of India. The norms is given to the asset management company. So for the open-ended scheme can invest the maximum of 5% of investment into such unlisted unlisted securities. Whereas a closed-ended scheme can invest maximum of 10% investment. The scheme cannot invest listed entity belongs to the sponsor group beyond 25% of its net worth. So there are the case in which if the investment is going to be proposed to the sponsor or any of the sponsor group companies, it should not be more than 25%. Only for the case in which the rated or we can say it is listed entities can be permitted into the sponsor company. The asset management company, you know that there is another regulation by the Securities Exchange Board of India Mutual Fund Regulation Act 1996. It's also establishing AMFI, Association of Mutual Funds in India. It is the industry association for mutual funds which was enacted during the year 1995. Principal objectives of Association of Mutual Funds in India. So the primary objective of AMFI that to promote the interest of mutual fund among the unit holders and interact with the regulators. So protect the interest of unit holders. So whoever investing in mutual funds, they call it as a unit holders. So like if I am going to buy the share, call it as shareholder or debt holder, or even if you are going to invest in insurance, you may call it as a policy holder. A similar way, if you are investing into the mutual fund, you may call it as a unit holders, because where you are going to buy the units from the asset management companies. So to protect the interest of the unit holders and to interact with the regulators, various type of regulators like the Securities Exchange Board of India, Reserve Bank of India, Government of India, and other regulatory authorities where the Association of Mutual Fund is interacting. And to set and maintain the ethical, commercial, and professional standards in the industry. The mutual fund industry is following the ethical standard in terms of giving the proper advertisement, commercial and professional standard to be maintained in terms recruiting of intermediaries and other officials, providing of proper training to them, statutory training that they need to complete from Association of Mutual Funds in India for entering into the operations of mutual funds. So the way in which the mutual funds are to be promoted by the asset management companies, where the guidelines of AMFI is to be given for asset management company in terms of selection training of the people who are required for the investment companies. To increase the public awareness, understanding the concept of working mutual funds in the country, to undertake the investor awareness program and to disseminate the information about the mutual fund industry, about its growth, penetration over the period of time. There are different mutual fund, the awareness programs are to be conducted for the welfare of the people. Frequently, the Aditya Birla Asset Management Company is conducting an investor awareness program. The benefit of investing into mutual funds, the caution to be taken by the investor before going to make investment into the market. Such kind of programs are to be planned for the benefit of a public to get awareness about the mutual fund, the benefits of mutual fund, merits of mutual fund, what are the limitations are associated with the mutual funds, can be explained to the investor. Investor should be aware before going to invest into the mutual fund. To develop the cadre of well-trained distributors and to implement the programs of training, certification for the intermediaries and the people who are engaged in the mutual fund industry. So there are different certification programs are to be offered, cadre with to understand the workings of mutual fund, the operations of mutual fund. Specifically for the distributors, they need to complete. The people who are associated with the mutual fund industry, they need to complete some basic courses like AMFI Mutual Fund Basic, AMFI Mutual Fund Advanced modules. There are different modules are being developed for the people who are associating with the mutual fund industry.